Click Holdings Limited completed its latest trading session on Friday, May 22, 2026, closing at exactly $1.41 per share on the Nasdaq exchange, marking flat movement with a 0% change for the day on a trading volume of roughly 85,000 shares. Because today is Sunday, May 24, the broader markets are currently closed, meaning this position represents the definitive price baseline heading into the final week of the month. Looking back over a wild multi-month timeline, this $1.41 valuation sits dangerously close to its absolute 52-week low of $1.32, illustrating a steep, painful erosion of shareholder value when contrasted against its historical 52-week peak that once reached all the way up to $21 per share. The immediate reality that completely shatters standard market assumptions is that while retail traders on popular self-investing applications are watching this stock bleed out on their portfolio dashboards, a massive institutional divergence is taking place under the surface. Most everyday participants looking at standard stock charts assume this microcap entity is quietly sliding towards insolvency or a permanent Nasdaq delisting. The hidden development that completely rewrites this script is the massive pivot the firm has executed into the silver economy and tech-driven elderly care systems within the Greater Bay Area of China. Just weeks ago, management announced an aggressive 3-year strategic initiative aiming to scale its annual top-line revenue to 500 million Hong Kong dollars by deploying advanced automated care technologies and securing key mutual corporate acquisitions. This is not just a struggling temporary staffing agency trying to survive. It is an active corporate restructuring play that is fundamentally transforming the nature of its underlying cash flows. When you scan the general investor consensus across mainstream trading networks, the shared expectation is that microcap listings trading under $2 are inherently toxic assets destined for continuous capital dilution. Retail investors checking their individual brokerage balances or exploring options on various popular investing sites usually treat names like this as speculative lottery tickets rather than viable businesses. The prevailing logic says that high-volume penny stocks cannot sustain a structural turnaround when macro liquidity is tightening. The contrarian reality you must wrestle with is that the underlying fundamentals of this business are actually showing intense operational acceleration that has yet to reflect in the equity price. In its mid-May financial disclosure, the organization officially reported that its seniors nursing division surged by more than 110%, allowing the broader entity to officially swing into positive profitability. This sharp contrast between the collapsing stock chart and surging profitable core business units creates an intense fundamental tension that traditional valuation models are completely failing to capture. Analyzing recent daily price swings reveals an asset caught in an intense institutional tug-of-war. The stock has experienced massive historical volatility, exacerbated by a massive 1-for-30 reverse stock split executed late last year to artificially maintain compliance with the minimum bid price requirements of the Nasdaq. Following that massive restructuring, the daily trading volume has occasionally spiked into the millions of shares during major press announcements, only to dry up entirely during broader market consolidations. This tells us that institutional day traders and short-term algorithms are actively using the tight public float of 1.66 million shares to engineer massive intraday swings. When a company has such a microscopic free float, even a small influx of buying pressure from retail participants using online investment portals can trigger massive upward momentum, just as easily as institutional liquidations can send the price cratering back to its baseline. The underlying technical structure of the equity shows that it has consistently run into severe overhead resistance near its short-term moving averages. Every single time the business attempts to stage a rally on positive fundamental news, it is met with intense selling pressure from historical bag holders who bought in during the double-digit pricing phase. Furthermore, the external legal overhang cannot be ignored, as multiple prominent shareholder rights law firms have publicly launched class action investigations regarding potential securities violations and past financial misstatements. This constant stream of negative legal headlines acts as a heavy psychological anchor, scaring away traditional wealth management firms and conservative retail allocators who prefer stable exchange-traded funds or blue-chip names. Institutional tracking data reveals that large block trades have been primarily characterized by defensive hedging, meaning smart money is waiting for definitive proof of execution before committing long-term capital. To fully understand why this fundamental disconnect exists, we have to look directly at the underlying corporate blueprint and operational machinery of the firm. The enterprise operates as a specialized holding company based out of Hong Kong, primarily focused on providing human resource management solutions, temporary and permanent talent placement, and tailored corporate services. Its customer ecosystem spans from certified public accounting firms and small to medium enterprises to non-governmental organizations and large public institutions. Crucially, the business model segments into professional solutions, logistics staffing, and its fastest-growing unit, nursing care solutions. Rather than acting as a simple manual matchmaker, the firm utilizes a proprietary automated database to source and deploy human capital across these distinct commercial sectors, allowing them to extract higher operational margins than traditional brick-and-mortar staffing agencies. Historically, the financial health of the firm was deeply tied to the highly cyclical and competitive Hong Kong corporate environment, which led to significant bottom-line instability. In past fiscal reporting periods, the entity faced severe margin compression due to rising domestic labor costs and regulatory compliance burdens within the human resources sector. The massive strategic shift occurred when management recognized the structural demographic shift across the region, characterized by a rapidly aging population and a severe shortage of qualified senior care professionals. By pivoting their core deployment mechanisms toward the elder care market, they tapped into an insulated, non-cyclical demand driver. They solidified this shift by securing critical government contracts, including high-profile partnerships with major postal service providers and local healthcare networks, establishing a highly predictable baseline of recurring B2B contract revenue. As we turn our focus toward the forward-looking horizon, the future performance of this equity will be entirely dictated by the battle between aggressive corporate targets and severe execution risks. The bull case for the company relies completely on its ability to execute its expansion into the $300 billion Greater Bay Area silver economy. Management has placed a heavy bet on integrating robotic care hardware and automated elderly support systems, predicting that these tech integrations will drive an incremental profit surge of over 50% by the fiscal year 2027. If the business successfully hits its target of 500 million Hong Kong dollars in annual revenue through these tech acquisitions, the current microcap valuation of less than $5 million will look absurdly mispriced to anyone reviewing the data on an advanced trading platform. The bear case, however, is grounded in the harsh reality of capital constraints and regulatory hurdles. Navigating cross-border healthcare regulations between Hong Kong and mainland China is incredibly complex, and any operational delays could rapidly burn through the firm's available cash reserves. Furthermore, the persistent threat of further equity dilution or another reverse split remains high if the market price fails to organically sustain itself above the compliance thresholds. Investors are left watching a high-stakes race where the company is trying to scale its real-world cash flows fast about its regulatory and legal liabilities. When you evaluate this entire operational picture, the contrast between market expectations and structural reality becomes completely undeniable. The market is pricing this asset as a failing, illiquid microcap listing that is bound to disappear from major exchanges. The operational reality shows an agile, profitable human resource and healthcare network that is actively executing a massive regional expansion into one of the fastest-growing demographic sectors in the world. It is the ultimate manifestation of microcap asymmetry, where the public perception is entirely dominated by historical chart destruction, while the present-day fundamentals are undergoing an intense structural transformation. I want to hear your perspective on this high-risk microcap setup. Comment below how many shares of Click Holdings Limited you currently hold, or if you are avoiding this corporate turnaround play entirely. To bring everything full circle, this enterprise stands as a prime example of how surface-level market metrics can completely mask a massive corporate evolution. The baseline expectation established by a collapsing multi-month stock chart suggests terminal decline, but the operational reality of triple-digit senior care growth and localized government contracts presents a completely different narrative. Whether management can successfully scale its technological integrations across the Greater Bay Area remains an open question, but the current structural tension ensures that this asset will remain a critical case study for analytical investors tracking small-cap market inefficiencies. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.